Hello, my name is Deb Gerber. I'm a certified public accountant with the Small Business Development Center located on the Idaho State University College of Business campus. The SBDC offers free consulting services to businesses who are just starting out, need financing, help with developing a business plan, web and graphic design, and of course accounting and taxes, which is what I do. The first tip I have for you is how to find a good tax preparer. Anyone can prepare taxes and file them for you, but professionals have an EA for enrolled agent or a CPA, certified public accountant, behind their name. That means that they have continuing education credits required of them every year. In the case of an EA, it's 16 credit hours, and in the case of a CPA, it's 40 credit hours. So that means they have to keep up on the latest things that are going on in the tax world. How you know if you have a good tax preparer is if that preparer takes time with you, sits down with you, asks questions, helps you understand what's on your tax return, gives you guidance on things that might be deductible that you're missing, and generally getting to know you so that they can prepare the best tax return possible. One of the things I've noticed so far in this very early tax season is that people are unaware that they need to bring in how much they received in the economic stimulus rebates from last year, and also the most current one in late December, early January. The reason you have to bring that in is because it goes on your tax return, and if you didn't receive enough money last year from your economic stimulus, say you had a new baby and it wasn't recorded yet, you're entitled to that rebate for that baby. If you had a child that was a college student, they may not have been, but they maybe should be on their own. And this tax return reconciles those two payments and gives you the extra money that you might be entitled to on the return. If you've received too much money, the government is not asking you to, is not going to take it back. It's just yours to keep. Another thing I've noticed so far this year is that because we've gone into an online format for most everything, if you signed up to have your bank statements or your W-2 or your paychecks direct deposited and you are totally online, you may not receive those documents in the mail. You may have to go online, remembering your login and your password to log in and get those documents. It happens to us all the time that if you are retired, recently retired, they forget that they have to go in and download those documents. I know, for example, that ISU just sent out an email that said that the W-2s are ready, so you should go online, download your W-2 and bring it in. The financial institutions and employers are required to give access to the 1099 or the W-2 by January 31st. That means they can put it in the mail on January 31st if they're mailing them, which is going to take a couple of days for the mail to get to you. So don't make your appointment until you know you have all of your documents. So let's talk about the standard deductions for a minute. What does that mean? Well, that means that you don't have a filing requirement unless you make a certain amount over the standard deduction. So the government says that you don't have to claim your income if you are single and made less than $12,400. If you're married filing joint and you're under age 65, the amount is $24,800. If you're head of household, which means you have a qualifying child, and you're under 65, that amount is $18,650. Basically, that means you don't have any, aren't going to owe any taxes. But you still might want to file, because if you had a job and you had federal income tax or state income tax withheld, you would like to probably get that money back and also qualify for some tax credits like earned income credit, child tax credit, or daycare credit. You have to file to get those credits. If it's in the state of Idaho and you're under the filing requirement, you have to file at least a grocery tax credit form in order to get that credit. many of these credits are refundable to you whether or not you owe taxes. So let's talk about the kinds of income that you need to put on your tax return. Many people, because of this pandemic that we have been in for the last year, have had to be reliant upon unemployment compensation. Unemployment compensation is taxable, so you should bring in the document that the state of Idaho is going to give you that says how much unemployment you received through December 31. Many people had to have all of the unemployment in order to survive, and they did not have taxes withheld on that. So you might want to prepare yourself for having a tax liability because you didn't have any taxes withheld from that unemployment. The state of Idaho did not have you fill out a form that required a withholding. So you probably will owe for the state of Idaho. Just a heads up, you might want to get in early and get those things done so that you have time to prepare on how you might have to pay that if your credits do not exceed your liability. In the field of medical deductions are all kinds of things that are for the improvement of your health, for the maintenance of your health, and for the bringing you back to a normal health. So things like hearing aids, hearing aid batteries, glasses, contacts, prosthesis, braces, dentist, pharmacy, doctors, office visits, hospital bills are all deductible, including the mileage to and from all of these places. So for example, if you have to go to Walmart to pick up a prescription, the mileage from your home to Walmart is added into the calculation to see if you qualify for medical expenses. Medical expenses are included in your itemized deduction. If you don't have enough standard deduction if you don't have enough itemized deductions to overcome the standard deduction, then we're just going to go with the standard deduction. But you might want to keep track of all of those things just to make sure. The tip for that is if you have medical bills that are piling up, it's when they're paid, not when they're incurred. So I would recommend that you pay them, like delay them and pay them all in 1 year, that maybe the beginning of the next year, and then add that year's medical expenses to it. So you have 2 years worth of medical payments in 1 year, and then that may help you with the standard deduction amount, the itemized deductions being over the standard deduction amount. Things and income that are not taxable are life insurance proceeds, gifts that you may have received from your grandparents or your parents that are less than $15,000 in a year. Some things are excludable from income to a certain rate. For example, Social Security benefits are included in income, but they're not fully taxable. So there are a lot of calculations that occur when a tax return is prepared. Student loan interest is still deductible. The maximum is $2,500. Let's talk about when your tax return is due. It's normally due on April 15th. You may extend the tax return by filing a document with the IRS. That extends the time to file, but it does not extend the time to pay if you should owe. So keep in mind that we'd have to help you make payment arrangements. We'd have to figure out some way to help you get those taxes paid. But there is a penalty that gets added to the tax return if the payment is not made on time. If you choose not to file and you owe taxes at a later time when you actually do file, there is a penalty for failure to file, and then it adds to the penalty for failure to pay. That penalty is up to 25% of the tax that's due. So it really is smart to get it filed, and we figure out how to get it paid as soon as possible. Whether you're a first-time home buyer or a current homeowner, those are still deductible as an itemized deduction. And again, the itemized deduction total with the contributions, the medical, the taxes that you pay, have to be more than your standard deduction in order for you to claim them as specific itemized deductions. One change is alimony. Now, Idaho doesn't usually award alimony to spouses who have divorced. But in some states, alimony still is a very important way to help the partner who was not a wage earner get on their feet and get going. In previous years, alimony was reported as income and was reported as a deduction to the person paying it. Those rules have all changed in 2020. Alimony is no longer deductible. If you had to take money out of your 401k in 2020 to help maintain your family while the pandemic has been going on, you may be eligible for a reduction in the early withdrawal penalty, but you should see your tax preparer to make sure that we're following those rules correctly. Another change that occurred in the last couple of years is that if you are in a trade, for example, a plumber or an electrician, and you were sent out by the union on various jobs, you used to deduct your lodging while you were away from home, your meals, your mileage, and your union dues and those kinds of things that are associated with your practicing of your trade. In 2018, those deductions were taken away in the new tax code. So union members can no longer in 2020 or back to 2018 deduct their union dues or any of the expenses that they have associated with the travel to perform that trade. However, if you are in those trades and you are a self-employed individual, that means you own your own business, all of those expenses are deductible to arrive at the profit. The profit is what you pay income tax on and self-employment tax on.